Hi, I'm Ruban Selvanayagam from Property Solvers. If you follow property headlines over the last few years, you've probably seen it. Landlords are selling up. The private rented sector is shrinking, and a flood of ex-rental homes is about to hit the market. Some go further and say we're witnessing a landlord exodus that could reshape house prices and the dynamics of the market in 2026 and beyond. But is that actually happening? Or is there another narrative that sounds bigger than the underlying data? In this video, I want to step back and look at what the numbers really show, using lending and transaction data, repossession figures, and longer-term structural trends, and then bring it back to the key question: what does this mean for buying, selling, and pricing property right now? Let's dive in. Over the last decade or so, the buy-to-let landscape has changed materially. Section 24 mortgage interest relief restrictions, introduced from 2017, reduced the tax efficiency of leveraged landlords holding properties in their personal name. Stamp duty surcharges on additional properties increased acquisition costs also. More recently, regulatory tightening has accelerated. The Renters' Rights Act expected to come in force in 2026, the effective removal of Section 21 no-fault evictions, tighter compliance obligations, and proposed EPC requirements for rental properties by 2030. Add to that Awaab's law extending stricter standards around damp and mould, and it's understandable that many smaller landlords feel the environment is more demanding than it was in 2015 or 2016. So the sentiment has shifted, but sentiment and scale are not the same thing. If we look at UK finance data, buy-to-let purchase lending peaked around 2015-2016 at roughly 120,000 purchases per year. That was the height of the post-crisis landlord expansion phase. By contrast, buy-to-let purchase lending fell sharply through 2022 and 2023 as rates reset, landing closer to 60 to 70,000 purchases per year. 2024 remained well below the mid-2010s peak. Provisional 2025 data shows activity stabilising but still materially lower than a decade ago, with annual buy-to-let purchase volumes running at roughly half their 2015 to 2016 levels. So yes, landlord buying activity is significantly lower than during the expansion era, but it has stabilised rather than collapsed as we move through 2026. But here's the key distinction: lower buying is not the same as mass selling. If there were a genuine landlord collapse, we'd expect to see a surge in forced sales and repossessions. According to UK finance data covering 2024 and the first 3 quarters of 2025, mortgage repossessions across all sectors remain below 10,000 cases per year, less than a quarter of the post-financial crisis levels. That tells us something important. We're not seeing distress-driven liquidation at scale. What we are seeing instead is a discretionary exit, and that matters. There's a big difference between landlords choosing to sell because margins have tightened and landlords being forced to sell because they can no longer service the debt. The first scenario increases churn. The second scenario triggers price collapses, and the data currently points to churn. If we widen the lens, the Office for National Statistics estimates that around 90% of households in England live in the private rented sector. That proportion has been broadly stable over the last decade. It expanded significantly between 2013 and 2016, and then plateaued. In other words, the private rented sector stopped growing rapidly years ago. What's happening now is more of a rebalancing rather than a collapse. Regionally, the picture varies. In parts of London and the South East, for example, yields have compressed to 3 to 4% gross, particularly in the most desirable areas. And although there are a number of London landlords that own their properties outright or unencumbered, when mortgage rates moved from sub 2% during the ultra-low rate era to 4 to 5% new lending rates in 2023 and 2024, the margin for highly leveraged landlords was squeezed. If your yield is 3.5% and your borrowing cost is 4.5%, you're relying entirely on capital growth to justify the hold. And capital growth, as we've seen from ONS and Land Registry data throughout 2024 and 2025, has slowed to low single digits, with London down to around 2 to 3% year on year in recent releases. Contrast that with the North West or parts of Yorkshire, where gross yields of 7 to 9% are still achievable on standard buy-to-let stock. In those markets, the numbers stack up more easily, even with higher borrowing costs. That divergence is crucial. So the so-called landlord sell-off is not uniform across the UK. It's concentrated in lower yield, higher value markets where regulation and tax bite harder relative to income. Now let's look at listings behaviour. Zoopla research has indicated that in some markets, over 30% of homes for sale were previously rented properties. That figure is notably higher in London, but again, context matters. London has historically had a high concentration of private rented stock. If a portion of that stock rotates into owner occupation, that's structural rebalancing, not necessarily panic. What about transaction volumes overall? HMRC transaction data through 2024 and 2025 shows annual transactions hovering around 1 million, give or take. That is lower than the post-stamp duty holiday surge of 2021, where transactions exceeded 1.4 million, but it is broadly in line with long-run averages. If landlords were dumping properties en masse, we'd expect to see a sudden spike in listings and a sharp increase in completed sales driven by investor exit. Instead, what we are seeing is a stable transaction flow with more price sensitivity and longer marketing periods. Mortgage approvals support this interpretation. Bank of England money and credit data for October 2025 showed net mortgage approvals for house purchases at 65,018 in that month. That's well below 2021 peaks again, but broadly stable compared with the second half of 2024. In other words, demand from buyers remains present. It's cautious and price sensitive, but it's not absent. So what's actually happening? In simple terms, the marginal landlord is exiting, and the core landlord is adapting. Some smaller accidental landlords, perhaps those who let out a former home or own one or two properties in their personal name, are deciding the regulatory burden and tax obligations are no longer worth the hassle. Here at Property Solvers, we're increasingly seeing landlords sell underperforming stock. That might be older HMOs facing higher compliance costs, licensing burdens, or increased scrutiny around damp, mould and energy standards. It might be properties in lower yielding areas where financing costs now exceed comfortable margins. In other words, some landlords are pruning portfolios rather than abandoning the sector altogether. They're disposing of assets that no longer justify the effort or capital tied up in them, particularly where management intensity is high and net yields have compressed. And with the Renters' Rights Act expected to remove Section 21 from May 2026, many are choosing to sell before the regime changes. That's rational capital allocation, not panic. At the same time, we're seeing incorporation trends. Many professional landlords are restructuring portfolios into limited companies, where mortgage interest remains deductible and corporation tax rates can be more favourable depending on profit levels. According to Hamptons, at the end of 2025, there were 443,272 active buy-to-let limited companies registered at Companies House, nearly 5 times the 91,278 recorded in 2016. In 2025 alone, 66,587 new limited companies were formed to hold buy-to-let property, an 8% increase on 2024 and a 363% rise over the past decade. That momentum has continued into 2026 with nearly 6,000 new buy-to-let companies registered in January alone, running 11% ahead of the same month last year. Then there's the institutional angle. Build-to-rent has grown materially over the last decade. According to British Property Federation data, there are now well over 250,000 build-to-rent homes either completed or in the pipeline across the UK, with tens of thousands under construction. Institutional capital, pension funds, insurers and large asset managers have stepped into the rental market at scale. This is critical. While smaller private landlords may be trimming portfolios, large-scale institutional investors continue to allocate capital to rental housing, particularly in urban centres and growth regions. They operate at lower leverage with longer-term horizons and are less sensitive to short-term rate volatility. In many ways, what we're seeing is not a collapse of rental supply, but a transition in who owns it. Alongside large-scale build-to-rent providers, I believe we're likely to see a higher proportion of SME portfolio landlords operating with a far more business-minded approach. These are not accidental landlords. They're holding property through limited companies. They're running tighter cost controls. They're focused on detailed net yield calculations, not speculative capital growth. And they're treating rental housing as a structured investment business, not a side project. In other words, the amateur layer thins out whilst the professional layer consolidates. So moving on to house prices, and I believe that the implications are slightly nuanced here. In areas where landlord-owned stock is heavily concentrated in entry-level flats, 2-bed terraces, 3-bed semis, that kind of thing, an increase in sales from landlords can add to supply in that specific segment. That can increase competition amongst sellers and strengthen negotiating power for first-time buyers, for example. But because these exits are largely discretionary rather than distressed, landlords are generally not accepting fire sale prices. They're listing at market levels and withdrawing if bids fall short. And that's a key difference from 2008 and 2009, when forced selling was driven by credit contraction, rising unemployment, and a generally unhealthy economic backdrop. And speaking of employment, despite growing concerns about automation and AI impacts on certain sectors, UK unemployment through 2024 and 2025 has remained relatively stable by historical standards. We've not seen a labour market shock that will combine with landlord exits to create systemic stress. Now let's bring this back to the core question. Is the landlord sell-off real? Yes, but not in the way the headlines imply. There's no evidence of a nationwide landlord panic. There's no surge in repossession. There's no collapse in completed prices attributable to investor liquidation. Instead, what we are seeing is a gradual unwinding of the most marginal, low-margin, highly leveraged parts of the buy-to-let sector. We're also seeing landlords become more selective. Fewer are buying in high-priced, low-yield southern markets. More capital is flowing towards higher-yield regional cities. And institutional build-to-rent is absorbing part of the supply gap left by smaller operators. For sellers, this means increased competition in certain segments, particularly entry-level flats in London and commuter belts. Pricing discipline matters more than ever. As Zoopla research shows, homes requiring a price reduction take around 2.4 times longer to sell than those priced correctly from the outset. In a market where buyers have choice, overpricing is punished quickly. For buyers, particularly first-time buyers, the shift may present opportunity. More ex-rental stock can mean more availability in price brackets that were previously tight, but affordability constraints remain real. UK finance data published in 2025 shows first-time buyers spending around 20 to 25% of gross household income on mortgage repayments, significantly higher than during the ultra-low interest rate era. So capacity to stretch remains limited. For landlords who remain, the environment is tougher, but not unworkable. Higher compliance costs and regulatory scrutiny means margins need to be stronger. Yield matters. Leverage needs to be conservative, but the private sector is not disappearing. If anything, the current phase looks more like professionalisation than collapse. So when you hear landlord exodus, it's worth asking, is this a structural reset of marginal players or a systemic sell-off? The data currently points to the former. And for house prices in 2026, that distinction is crucial. A churn-driven market behaves very differently from a distress-driven one. The former leads to longer marketing times and sharper negotiation. The latter leads to rapid repricing. We are firmly in the churn camp, I believe, and not a crash camp. As always, the housing market absorbs pressure unevenly. Some areas will feel more supply, some segments will see more competition, but broad-based collapse requires forced selling at scale, and the evidence for that simply isn't there. And as ever, the key isn't the headline, it's understanding the mechanism behind it. And that's what really separates noise from signal. A big thanks for watching to the end. If you've got a spare moment, please like and subscribe to the channel if you haven't already. And if you're interested in deeper dives into auctions, pricing strategy and investor behaviour, I'll link to our Property Solvers auctions and Property Solvers investor channels in the show notes below. Thank you again.